What is up, internet family? It is so good to see you. If you're new to REIT investing, or you just want to have a better understanding of how REITs or real estate investment trusts work, this video is for you. I'm going to show you how you can participate in these type of investments and collect rental income every single month for usually less than $100 at a time. In this video, I'm going to be providing you the key takeaways when it comes to real estate investment trusts, what you need to know, be aware of. I'm going to be discussing the pros and cons of these type of investments. And lastly, towards the end of the video, I'm going to discuss what my personal experience has been investing in REITs over the last 4 to 5 years. And I'll give you guys just a few basic examples. With that being said, let's get started. Quick reminder, if you liked the video today and you want to support the channel, drop a like and leave a comment down below, and consider subscribing if you're brand new to the channel. I gotta tell you guys, investing in real estate has never been easier than it is today. You can begin to purchase rental income every single month without being a landlord, without having to go hunt down properties, and without getting yourself stuck into a large mortgage. It was in 1960 when President Dwight D. Eisenhower signed legislation that created a new approach to income-producing real estate investments, a manner in which the best attributes of real estate and stock-based investments merged together.
So you're saying that the real estate market and the stock market made a love child?
Yeah, sort of. And that love child is known as a REIT, or Real Estate Investment Trust. So real estate investment trusts give investors, in particular small investors, access to income-producing real estate assets. And this investment model has been so popular now. It's been around for about 50 years and has flourished throughout 35 different countries. In my personal opinion, this is by far the easiest way to invest in real estate or income-producing real estate, more than any other option available. But like any investment, it does have its drawbacks, which we're going to discuss shortly later in the video. There are two primary types of real estate investment trust. The first type is known as an equity REIT. The second type is known as a mortgage REIT. Now, roughly 80 to 90% of REITs available today are equity REITs. So let's start there. Equity REITs invest in hard real estate assets. Equity real estate investment trust revenues are mainly generated from rental incomes from their rental real estate holdings. Mortgage REITs, on the other hand, invest in mortgages only. So you have a partial ownership of the mortgage. And they make up less than 10% of the REIT market. Mortgage REITs mainly generate their revenues from the interest that is earned on those mortgage loans. For the purpose of this video, I'm primarily focusing on equity REITs because that's the most common form and the ones people are more likely to invest in. But just know that mortgage REITs do exist and they are an option. And I will tell you, in some circumstances, some real estate holding companies or some of these real estate investment trusts may have a mix of equity REITs or equity holdings, also mortgage holdings as well. So they do exist. There are some hybrid REITs out there, but they're not as common. It's usually one or the other. Now, there are so many different kinds of REITs. Blew my mind when I saw this chart. So the chart you're seeing on screen depicts many of the REITs that are available to you today in terms of what type of properties these real estate holding companies own. There's properties that stem from retail, so your commercial shopping. You could have there could be apartment buildings. They could be medical facilities such as hospitals. They could be retirement or senior living homes. It could be billboards, banking or bank buildings. They could own entertainment properties such as like Topgolf or movie theaters and things like that. You can even ones for prisons. I cannot believe that you can actually hold an investment that rents out or utilizes prisons, and you can make money from it. Its options are fully available, and it seems to be that there will be more real estate holding options in the future based on this chart. Here are a few of the key takeaways and the things I think you really need to know and understand before diving in to investing in REITs with your hard-earned money. Equity REITs are responsible for acquiring, managing, building, renovating, and selling real estate. Bottom line here is you're not the one managing that property. You're not a landlord. You don't have to deal with the headaches a landlord has to deal with. But you do get the benefit of collecting that rental income. And that rental income comes to you in the form of a dividend. And that dividend might be monthly or it might be quarterly, depending on the type of real estate investment trust you've invested in. REIT companies receive favorable tax treatment But one of the primary requirements for a company to be considered a real estate investment trust is they must pay out 90% of their earnings to their shareholders. And this is not just an option, this is actually required by law. So that tax benefit they receive is when they actually can deduct from their earnings the amount of the rental income they distribute out to their shareholders. But of course, with that tax break comes the responsibility of actually paying that money out whenever it comes due. Generally speaking, the income from these REITs is generally paid out on a quarterly basis or on a monthly basis. Half of my REITs are paid, I receive dividends quarterly, and half of my REITs pay dividends to me on a monthly basis. It's a common misconception that REITs can avoid taxes altogether, because that's not true. REITs actually are subject to income taxes like any other operating business, but they function more as a pass-through entity. Well, what's a pass-through entity? A pass-through entity basically earns its money, and after expenses, the net earnings are then passed out to the shareholder. So in this case, the REIT is distributing 90% of its earnings. They're passing those earnings out to the shareholders, where they will be taxed. Those earnings will be taxed at the shareholder level, at their personal return level, not the company level of the REIT itself, but on your own individual tax return if you're investing within a REIT. What is quite amazing to me as I dived into it, as I learned more about these REITs, is that many of them own not only hundreds, but some of them own thousands of properties, thousands. So when you're buying into a REIT, you're buying into a diversified portfolio of real estate. So for example, that portfolio could own hundreds of apartment units. It could own thousands of units of residential real estate. It could own hundreds or thousands of units of commercial property, etc. Real quickly, let's run through that list of pros and cons for these type of investments. Let's start with the pros. The first pro on my list is that, in my opinion, this is the easiest way to invest in real estate. All you do is purchase shares of the REIT company and wait for the dividend check to come in. That's literally all you do, is you find the REIT, the stock, or ETF, you buy it, and you wait for your money to come in. That's it. The next thing is REITs are a great way to begin replacing your income or supplementing your income slowly over time. Whether you're wanting to retire or whether you're wanting to supplement your income right now, a REIT is a fantastic way to begin doing that.
Mike, don't forget to tell them about the Roth IRA. They're gonna want to know about that.
Thanks for the reminder, Chipper. When investing in a REIT, you're not going to avoid taxes, but there is a way you can avoid taxes, at least to an extent, is that if you want to invest in this type of investment, you can purchase that investment, this real estate investment trust, purchase it within a Roth IRA. That way you're going to collect the dividend income, or the rental income essentially, and it's going to come to you completely 100% tax-free. So as much as possible, if you're a long-term investor, if you don't plan on retiring anytime soon, and you want to build up a nice tax-free income for retirement, a REIT is a fantastic option to look into in order to accomplish that. Another great thing about REITs is they're very liquid. Unlike holding an actual piece of real estate, you can actually, because it's a stock or an index fund, you can actually sell that REIT anytime you want and get out of it. And then you're hands-free. There's no mortgage to deal with, like I said. You don't have tenants to deal with. You can just get in and out of these REITs as you please. Another pro of REITs is that I think it's really easy to diversify. Now you might think, well, Mike, didn't you say they own thousands of properties already? Is there really a need to diversify? Actually, there is. So many of the REITs you'll come across, they usually hold hundreds or thousands of units of property, but that's typically all concentrated in one type of property. It could be like entertainment properties, or it could be all commercial properties or industrial properties. So you can actually diversify. So think of your portfolio and think of just REITs in general. You can actually get a diversified portfolio of REITs by purchasing REITs that hold different types of property units. And I think you're going to want to do that because there's always a chance that one type of unit can be impacted if the economy takes a plunge or if the economy takes a big hit. So that's something to be mindful of when exercising your options to invest in REITs. The last two pros I think that I want to mention is REITs have a much higher yield than the average dividend yield on other types of stocks. Lastly, not only do you get this consistent yield, you get consistent returns or income every year, but you do have a chance for capital appreciation as well. Now let's dig into some of the cons of these REIT investments. One of the biggest cons of REITs is that you're stuck paying the tax, especially if you're investing in these REITs within a taxable standard brokerage account. You're not going to be able to avoid the tax. Now, unlike other dividends from, like, let's say Coca-Cola or Pepsi, or like a normal company that's not considered a REIT, you can get qualified dividend treatment, which means you pay taxes at capital gain rates, which are lower. And I've discussed this in many of my other videos. With a REIT, however, you're stuck paying ordinary income rates, or your marginal tax rate. Now, for most people, that's anywhere from 10 to 22%, depending on your marginal tax rate. But the fact of the matter is that you cannot avoid tax on these things if they're in a taxable brokerage account, and you'll always pay tax at your highest marginal tax rate on these investments. Something you have to consider. In other words, they're taxed just like your wages at your job. What you'll notice if you dive into the dividend history of a lot of these REITs, because they're required to pay out so much of their earnings to their shareholders, you're not always going to get the same amount of dividends. I mean, you likely will, but there's a possibility you won't. So what I'm saying is there's some income fluctuations that might come into play, so just be aware of that. Another con is REITs can be sensitive to fluctuating interest rates, especially as interest rates rise. Since these companies, these REITs, they rely heavily on capital in order to borrow, in order to purchase these different properties. It's because they are short on cash, because they're constantly distributing out cash to their shareholders. Piggybacking on this last one, because they are passing out so much of their cash to their shareholders, they really don't have a lot of extra money to develop the company, because they're stuck with the 10% that remains of their earnings. And so they have to be careful about how they grow the business. And so you do have a good chance of appreciation, capital appreciation, in addition to that dividend yield, but it's not as likely. As I mentioned earlier, most REITs specialize in a single property type, so in order to achieve true diversification with your REITs, it may be necessary to own several types of REITs that hold different kinds of properties. Another con is you have virtually no control over the way the properties held within the real estate investment trust are managed. So that's a downside. So what you'll often find, and I'm not going to go into detail here, but I think if you actually owned a piece of real estate, a property of your own, or like let's say it's a single family unit or a commercial property and you were renting that out, you could often achieve much higher returns by being a landlord. So I think in general, the returns are much higher on owning an actual piece of real estate versus investing in real estate through a stock like a REIT. But, it's more hassle is more reward. Less hassle, less reward. So those are the trade-offs. The last thing I want to mention is that the value of REIT shares can decline if the properties they hold themselves decrease in value. Now, overall, my experience with these real estate investment trusts has been a positive experience overall. I'll be honest with you, I haven't received a tremendous amount of appreciation as opposed to my other investments, but REITs definitely make up a good chunk of my portfolio, and I've been happy with them overall. So I own REITs that hold entertainment properties, REITs that hold commercial properties, medical properties, and even REITs they own buildings that house computer servers for cloud computing, which is a very popular thing now, and I can see that going well into the future. So there's different kinds of REITs I own to diversify myself, and I will be purchasing more REITs in the future. But like any investment, I want to limit my portfolio to a certain amount in terms of how much I'm willing to invest in REITs. Because really, REITs only represent, gotta remember, they only represent one sector of the economy, and that's real estate. Currently, how much do I make from REITs? Well, if I take my REITs, if I look at the portion that pays me monthly, and I look at the portion of my REITs that pay me quarterly, and I annualize that amount, then I currently make about $103 per month from just real estate investment trust alone in dividends. Some of those dividends are from a Roth, so they're completely tax-free, and some of them are within my brokerage account, which is taxable. Two examples of REITs I own include O, which is the Realty Income Trust, which is probably the most well-known REIT on the market today. I think they've been around for over 25 or 26 years now. Very conservative company, does great at managing their cash, their profits, and things like that. So I recommend you checking them out. I think they have about a 4% yield right now, and they pay monthly. EPR is a REIT I've held for a long time now, and they own entertainment properties such as movie theaters, Topgolf, amusement parks, and things like that. which I think what I'll do is I'll make, especially if you want to see a video around this kind of stuff, guys, is I think what I want to do is make a video dedicated just to my REIT holdings and go over my experience with REITs with you guys. Let me know if you would like to see that. Now, fair warning with REITs, it can be extremely addictive to be able to purchase rental income every month, because that's essentially what you're doing when you're buying REITs, is you're purchasing more rental income every single month to supplement your current earnings. But remember, REITs only represent one sector of the economy. There's 10 other sectors of the economy that I don't want you to ignore. You have to keep all this stuff in mind when you're investing in these things. So because in the other sectors of the economy, you might actually be able to obtain even higher returns. A minute ago, I mentioned a few of the stocks I own, like Realty Income Trust and EPR, but you don't have to go the individual stock route if you want. You can actually purchase REITs through ETFs. I think the Vanguard ETF for real estate, like the Real Estate Investment Trust, is VNQ. And if I said that wrong, I'll make sure I correct it on screen here. But that ticker symbol within that ETF, you can just buy that one index fund, and that one index fund from Vanguard owns numerous different kinds of REITs. If you want to invest in REITs through an index fund, you can even invest through REITs through mutual funds within your 401k if you choose to do so. All right, ladies and gentlemen, well, that is all the information I have for you in today's video. If you liked the video, make sure you subscribe down below if you're new to the channel, and make sure to drop a like. I look forward to reading your comments down below in the comment section. Until then, have a fantastic week, and take this information and use it to live your life on Cage. Take care, everybody. Love you all. Peace.